Bitcoin, or as the popular Gravel Institute describes it,
to a Ponzi scheme.
So if this massive channel calls Bitcoin a Ponzi scheme and says millions of investors are on the brink of losing all their money, we should assume that their claims are grounded in theory and supported by data, right? Well, Gravel Institute's video makes the following claims to assert that Bitcoin is a scam. Bitcoin is a currency with the volatility of a penny stock. Bitcoin is a gambler's paradise that relies on an ever larger pool of investors. Bitcoin consumes a lot of electricity. This energy usage is bad for the environment. Bitcoin isn't useful at all, except maybe as a symbol of how capitalism has changed. And finally, Bitcoin has formed a culture of its own, around a society without purpose. And all of these arguments sound very logical, but how do they hold up if we investigate a bit further? The Gravel Institute uses a few points to back its first claim. The first point, Bitcoin is a currency that fails to do its job, does have some truth to it. Compared to other currencies around the world, Bitcoin is a small fish in a large pond. Governments back those currencies with guns, most don't have the volatility of a penny stock, and they have a faith behind them built over centuries.
It all seems sort of fake.
Well, it's a fiduciary system. It's all faith-based, right?
Oh my Lord.
Yes, you got to have confidence in that currency, in that dollar, because there's nothing backing, there's no gold backing it.
So it's in some ways, it's a mass delusion.
Well, that's a harsh word, but
For Bitcoin to compete in that environment in the early stages of its existence is similar to saying a small retail store should provide the same services as Amazon. Over a long enough time, the retail store could take a large share of Amazon's market, but it's likely impossible in the short term.
in terms of, with all this printing, you see these cryptocurrencies, these Bitcoins,
Right.
which are basically virtual currencies.
And faith-based to some
And
extent.
faith-based.
So in reality, you can't call Bitcoin a Ponzi scheme without calling every government-backed currency a Ponzi scheme as well. Because at the end of the day, both are just faith-based units in a ledger that we call money or currency. And on top of that, for years, debates centered around whether Bitcoin should optimize for storing value or frequent transactions. As a result, multiple hard forks like Bitcoin Cash and Bitcoin Gold were formed by copying Bitcoin's original blockchain and taking it in a new direction. Each of these hard forks optimizes for increasing transactions, and when you compare them to Bitcoin, each hard fork is now a fraction of the size. This is because the market prefers Bitcoin's base layer as a store of value and transaction settlement network rather than a processor for many small payments. The second point states that Bitcoin is rarely used to buy goods and services.
When people buy Bitcoin, they rarely use it to buy goods and services.
Fortunately, we can see Bitcoin's transparent ledger and determine if this is true. As of March 2022, 76.5% of all Bitcoin in circulation have not moved from their address over the previous 6 months. So their point is valid. People rarely use Bitcoin for everyday transactional purposes. However, instead of just leaving it at that, it helps to understand why that is. When a government issues currency, they want their citizens to spend it. A smooth flow of money gets capital to all participants and allows debtors to repay their debts easier. To put simply, our current monetary system is built upon a layer of debtors and creditors. These people accumulate more debt than their ability to repay those debts.
Think of borrowing as simply a way of pulling spending forward. In order to buy something you can't afford, you need to spend more than you make. To do this, you essentially need to borrow from your future self. In doing so, you create a time in the future that you need to spend less than you make in order to pay it back. It very quickly resembles a cycle. Basically, anytime you borrow, you create a cycle. This is as true for an individual as it is for the economy.
If the flow of money doesn't reach those highly leveraged people, the entire system can collapse. As a result, you can see policymakers attempting to increase the flow of money in the system by using various tools like lowering interest rates or encouraging infrastructure bills. This runs opposite to Bitcoin, as most of its users prefer to use it as a store of value. The current usage of Bitcoin as a store of value and government currency as a medium of exchange is not surprising. Gresham's law, an economic principle stating that bad money drives out good money, applies to this situation perfectly. In this case, the bad money, being the government currency with an unlimited supply, is more appealing to get rid of or transact with than Bitcoin with a scarce supply. The next point states that people only buy Bitcoin to speculate on its price.
Only 1.3% of Bitcoin's economic activity is in merchant transactions. The rest is speculation, people buying it just because they think it will go up. And the more it's used in speculation, the less incentive people have to actually use it as a currency.
New investors come into the space with the idea of getting rich quick. There is also Google Trends search data that supports this claim. Most investors research after acquiring Bitcoin, and many realize it offers utilities outside of quick gains, such as instant national and international settlements, censorship-resistant payments, and a scarce and hard cap supply. It's a common belief among Bitcoin users that central banks manipulating money incentivizes people to speculate. To protect their purchasing power, people need to find a yield higher than the inflation rate. This causes speculation in all asset classes, especially scarce objects like Bitcoin. And then they say Bitcoin is too volatile to be a currency, which again has some truth to it.
Well, Bitcoin is certainly one of the more volatile assets out there. And so that's really true for any kind of monetary asset. And so we've built up fine art prices to very high levels. And we could see, next year that a lot fewer people want to buy that fine art. And suddenly, they all kind of, millions of them come to the realization that they should pay a third as much. And so, that's one thing to monitor. Same thing, there are $40 million beachfront homes, throughout Florida, and you could find out that, maybe, next year they all want to pay $10 million for those. And it's, it's certainly possible, but there are a lot of on-chain indicators you can use. And so, for example, we can see what long-term holders are doing with Bitcoin. And we see that as the price goes up much, much higher, they're slowly willing to sell, some of their tokens because they've gone up 5x or 10x in some cases. But you don't see a lot of kind of movement from those long-term holders. A lot of those intermediate term, kind of like the near-term kind of price volatility, a lot of that has to do with the trading activity that we see on exchanges, whereas the long-term holding is actually kind of a steady thing to watch, similar to accumulating other types of property.
Most people don't use it as a currency because it is volatile, or they believe that spending it is a bad choice compared to holding it. But that doesn't mean it doesn't work as a currency. Many people across the globe in places like Cuba, Venezuela, Palestine, Sudan, and Nigeria flee to Bitcoin to escape from a broken financial system. People in those countries and other countries in similar situations don't worry about the volatility. Their main concern is maintaining their purchasing power during economic turmoil. So the claim that Bitcoin is a currency and needs to work like the current payment systems of the Western world is a bit far-fetched. Bitcoin has no rules other than the code that governs it. Nothing says you need to treat it as a currency, a store of value, or a speculative get-rich-quick scheme. It's up to the user to determine its utility. The Gravel Institute's second claim, stating that Bitcoin is a casino that requires an ever larger number of gamblers, uses the following points. They first assert that Bitcoin has no inherent value. This may be true in some people's eyes, but how does it hold up when we use the same argument for collectibles or commodities?
The answer that I have to that is, well, I mean, what's the intrinsic value of that Mickey Mantle baseball card that sold for $5.5 million? It's just cardboard, and it doesn't even have a legend. It could be counterfeited very easily. Or what's the intrinsic value of a Picasso painting, which is just canvas and paint, and maybe a frame, but people will pay millions or tens of millions of dollars for it. And so it comes down at the very basic level for supply and demand. So Bitcoin is the only economic entity where the supply is unaffected by the demand. So even with gold, if gold, which is $1,800 today, if gold goes to $18,000, there will be a lot more gold mined because mines that are unprofitable will become profitable. And so gold, which accretes today, the production of gold is equal to about 1.5% to 2% of the total value per year. That's the same accretion that Bitcoin has currently. But this year, 2022, I think will drop below 1.5% on that. So only 21 million Bitcoin can ever be created or close to it. It doesn't matter if Bitcoin is 100,000 or 20 million, there's only going to be that many of them. All you have to really believe is that the demand for Bitcoin will grow faster than 1.5%, over the next number of years, and the price inexorably will go up.
Not to mention our government-backed currencies, like a dollar, are objects made out of paper or represented on a digital bank ledger, with no inherent value. When we work or sell something to acquire dollars, we do so only with the faith that we can take these pieces of paper and give them to someone else for something of value. So the currencies we use every day have no inherent value, they're just backed by the faith of the citizen base and men with guns. And to the second point,
Anything you invest in Bitcoin or Ethereum or Dogecoin just goes into the pocket of the previous holder. There's no real income generating asset behind it. What they're betting on is that other people will bet on it and the value will keep going up.
you could apply this argument to any non-income collecting asset like collectible cars, gold, fine art, fine wine, or even Pokemon cards.
Really any non-cash flow producing asset is only worth what you think someone else is going to pay you for it in the future. And that's true for Bitcoin, that's true for gold, that's true for, fine art, beachfront property that you don't plan to rent out. All these kind of high-end kind of scarce goods, they're always based on, their scarcity and their desirability. And one thing that they all have in common is that they have some degree of utility, right? So, fine art has utility, a classic car has utility, beachfront property has utility, gold has utility, but they also all have a monetary premium associated with them. And so they're bought for, more than just their utility. And Bitcoin's kind of a similar way because for its utility, you have, permissionless international payments that pretty much can't be stopped and easy mobility of funds, right? So you can just remember a 12-word seed phrase and go anywhere in the world, across borders, and basically transfer wealth wherever you want. That's its utility, and then it has that monetary premium due to its scarcity. And so the overall point of the article is that Bitcoin still has a variety of risks. It's going through an adoption period, and we'll see how far it gets. But it doesn't really meet the definition of a Ponzi scheme more so than any other kind of non-cash flow producing monetary asset.
People invest in these scarce objects to collect a yield that is higher than the inflation rate, with the main reason to protect their purchasing power. And to the third point, every Bitcoin investor needs to find a sucker to sell to. This is true. Every seller needs a buyer. The gold sellers need a gold buyer, the baseball card seller needs a baseball card buyer, and yes, even you need someone to take your government currency when you want to buy something. And their other point states that other speculative cryptocurrencies offer higher returns while promising much less. This is true. Thousands of other cryptocurrencies claim to offer different use cases to Bitcoin. However, while you can duplicate the open source code very easily and create your own crypto, you can't duplicate Bitcoin's users, developers, and attention to your crypto project.
Anyone can technically copy it. If Bitcoin's open source, you can copy it, you can run it. It's kind of like how you could copy Wikipedia and you could run it. The problem is getting traffic to whatever you're doing and sort of a community. And so with Bitcoin, you have over 10,000 nodes around the world running it. And some estimates are far higher because not all of them are visible. And so that can't be replicated just by copying the code. It's really about all the software that's designed to work with that particular protocol, as well as the developer community and the company ecosystem around it. So, hardware support for it, security solutions, exchanges that accept it. And so that one particular protocol has developed such a strong network effect relative to all the other coins. And that's why over the past decade, 5,000 coins haven't been able to really take a lot of market share from Bitcoin.
It's also important to note that 99% of cryptocurrencies are devalued to near zero levels when measuring in terms of Bitcoin. This is why Bitcoin is unique compared to other cryptocurrencies. You can't replicate its large user base and its network effect. Many people use the word cryptocurrencies to group all the tokens into one category. For example, suppose scam coins are attracting the eyes of investors. In that case, Bitcoin can get lumped into that discussion simply because people classify it as a cryptocurrency. However, it's important to look into the details and differences. Lumping all cryptocurrencies together would be like lumping stocks together. You wouldn't call Amazon a scam because Madoff Investments was a Ponzi scheme. In the same way, you wouldn't call Bitcoin a scam because other cryptocurrencies are Ponzi schemes. It's easy to say new cryptocurrencies will come up and take Bitcoin's place. Still, people don't consider it impossible to duplicate Bitcoin's user base, developers, and secondary layers when making this argument. Without these things, any crypto will be a shell of what Bitcoin offers. Also, Bitcoin is easy to call out as a casino since it's a new technology with a lot of speculation. However, any of those previous points referring to its value can be applied to commodities, collectibles, and yes, even the government currencies we use daily. So if your argument is so broad it includes every commodity and collectible known to man, you may need a better argument. The Gravel Institute's third claim attacks the energy consumption tied to Bitcoin mining.
Because of how complex Bitcoin transactions are, they consume an incredible amount of power. One Bitcoin transaction consumes more electricity than the average American household does in a month. Bitcoin as a whole consumes more electricity than entire countries: Venezuela, Bangladesh, Pakistan, Kazakhstan, and the Philippines. If Bitcoin ever were to be widely adopted, it would consume many times more energy than is produced in the world today.
The points make it sound like this energy consumption goes to waste. Bitcoin does consume a lot of electricity, and in fact it consumes the most energy in the entire crypto ecosystem, but in reality Bitcoin's energy consumption makes it the most secure blockchain in the world, and it's the main reason no person or government can control it. When saying one Bitcoin transaction uses as much energy as an entire household in 1 month, there's a giant flaw to that statement. Bitcoin's energy consumption doesn't secure individual transactions, it secures the whole blockchain. From the first transaction ever made to the transactions happening as you are watching this video, if no energy secures the blockchain, all transactions are at risk. This also ties in nicely with Bitcoin consuming more energy than some countries. Each nation shown in the video has a lower GDP than Bitcoin's entire market cap. So it's no surprise that Bitcoin consumes more energy when it also protects 2 times more wealth than each of those nations' GDP. The primary purpose of a nation-state is national security. For example, the Philippines, with a GDP of $361 billion a year, needs a government to protect its people's wealth and property, ensure the laws are being followed, and use military force if necessary. All of those things require energy and frictional costs like taxes for the system to function properly. The Bitcoin network acts in the same way, except in this case, its top priority is network security or the security of its blockchain. The consumption of energy and fees associated with Bitcoin mining assures its users' wealth and property rights are secure, and the network can withstand country-sized attacks.
You know, the power behind every bullet, every bomb, every ship, every sub, every tank, every truck, the heartbeat of every service member that we have, that is all measured in watts. We are spending watts to defend our property. We don't have to spend those watts and risk Americans dying to defend that property. We can just pay an electricity bill. I feel like that would be a better deal for everybody. So why don't we monetize the underlying property of this self-defense network? And by the way, it might not be a negotiation. And if it's not a negotiation and our adversaries move first, that's a dark future.
Bitcoin's energy consumption will increase as more users adopt it, just as a country's energy consumption would increase if its population doubled. Bitcoin holders would argue that energy usage benefits the network and results in higher security and property rights. On top of that, there is the moral case that Bitcoin security incentivizes peace, in contrast to governments and militaries incentivizing violence. The next argument claims that Bitcoin would not be useful in a normal capitalist society. Instead, our current crony capitalist society highlights its use to people.
Bitcoin isn't useful at all, except maybe as a symbol of how capitalism has changed. From something that could once build factories and transcontinental railroads to a system of pure speculation, totally divorced from the real world.
Their main point here is that Bitcoin has no actual use. This is ironic coming from a company located in New York. Why would they need Bitcoin when they are located in the world's financial capital? To the people trying to escape the broken financial systems of the world, Bitcoin has utility. To the people trying to maintain their purchasing power from the wrath of inflation, Bitcoin has utility. To the people that prefer to send money freely without risk of censorship, Bitcoin has utility. To those that live in downtown Manhattan with close connections to the bankers, may not need Bitcoin, but that doesn't mean they need to be blind to those who rely on it every day. And to the point on how capitalism has changed, many Bitcoin users would agree. The main difference in viewpoint would be that Bitcoin users see it as a tool to opt out of the current crony capitalist system. Not to mention, founder Satoshi Nakamoto left a message saying, "Chancellor on brink of second bailout for banks," in the very first block of Bitcoin transactions. The message was from a newspaper headline during the 2008 financial crisis, when the government would bail out banks while doing very little for the common person. This set the tone for the Bitcoin project, specifically calling out cronyism since the project's inception. Their final point lays out problems with our current societal culture, saying that a society without purpose has flourished the growth of Bitcoin as people look for something to latch onto.
Bitcoin has become a culture, an identity. Amid the vast meaninglessness of a society in decline, a lot of people find value in it. In a world where traditional forms of identity are in decline, family, unions, religion, new ones like cryptocurrencies spring up to take their place. The fact that so many lonely, atomized people find community and meaning in Bitcoin means that for the people at the very top, people with millions or even billions of dollars, there's a ready and willing community of suckers to exploit.
This same argument could be applied to politics as well, where people looking for meaning latch on to progressive ideas. Or on the other hand, with Gravel Institute's competitor, PragerU, where people looking for meaning latch on to conservative ideas. For some users of Bitcoin, they too see society as losing its meaning, where 20th century financial systems and institutions are no longer functional in today's digital age, where money has been manipulated by central bankers to support fake economic growth, where free and open markets are no longer free and open, where the printing of money is used as a weapon to finance wars while inflating the costs onto the citizens, where inflation is transitory until it's not, where billions of people in third world countries don't have access to the existing financial system, where your money and property can be seized at the whims of somebody else. Where all of that is true, Bitcoin is hope for those who want to opt out of that system.